All right, my friends, listen closely because what's happening in silver right now is the kind of move that doesn't knock politely. It kicks the door in. We're watching a market that spent years being laughed at, ignored, and managed suddenly start behaving like it has a mind of its own. And the scary part, the loudest signals are not coming from headlines. They're coming from the places where real metal has to show up on time. As you're watching this, New York silver futures have been trading in territory that used to sound like fantasy. We're talking about prices pushing above the mid-90s. Meanwhile, if you convert what's happening in Shanghai into comparable terms, you're looking at silver priced even higher with levels that effectively put it above $100. Now, stop right there and let that settle. Because whenever one major hub is pricing metal higher than another, you don't just get a cool chart, or you get stress, you get pressure, you get a tug-of-war over physical supply. And when that tug-of-war starts, it rarely ends quietly. Before we go deeper, I need one quick favor, because my analytics are screaming something at me. A huge chunk of you watch these videos to the end, but you still haven't subscribed. If you value the work John AG is doing here, hit subscribe and drop a quick comment, even our John AG, so the algorithm knows this channel is worth pushing. All right, now let's connect the dots. If you've been following the silver story at all, you already know that the real game isn't just paper contracts. It's the physical flow between vaults, refineries, manufacturers, and the places that promised delivery. Last autumn, London gave us a warning shot. We saw a supply strain show up there, the type that gets downplayed until it can't be hidden. That tension didn't fully explode into chaos at the time, partly because extra metal was pulled in from outside silver that moved out of China and out of the United States to relieve the pressure in London. But here's the question almost nobody asked out loud. If London had to be rescued by pulling supply from other regions, what happens to those regions after the rescue? That's where the story gets wild. Because while London was catching its breath, the visible silver inventories in China were already moving in the wrong direction. The data has been showing a drain. And lately, that drain has looked like it's approaching the perilously thin category. In plain English, the cushion is getting smaller. Some people hear a little over 1,000 tons and shrug. But when you translate the numbers into ounces, it becomes easier to feel the reality. We're talking about vault totals on the order of a few dozen million ounces. That might sound big to a normal person. In a world where industrial demand eats silver like oxygen, it can be frighteningly small, and that's why the next development matters so much. A couple weeks ago, we started hearing reports that manufacturers in India, especially the ones tied to solar panels, weren't just shopping like normal. They were reportedly reaching beyond their usual suppliers and dialing up producers in Latin America, trying to lock down supply directly. The message was basically, we'll pay above the benchmark. We need metal, and we need it now. The premiums being discussed were not pennies. They were described as being in the range of roughly 8 to 10 over the COMEX linked benchmark. And the reason given was simple, almost blunt. China is soaking up silver, and it's making it harder for Indian manufacturing to source what it needs. Now, when you hear that, you might think, okay, interesting rumor. But then the market did what it always does when a rumor is real. It confirmed it through premiums. Because just recently, dealers in India were reported to be charging sharply higher premiums on precious metals. Gold, which had been trading with discounts not long before, flipped to strong premiums above spot. And silver premiums in India, they surged to roughly $80 an ounce above the benchmark, surpassing earlier spikes. Let me slow down and make sure you understand why that's a big deal. The benchmark price is the headline price. It's the one people argue about online. Premiums are the extra cost real buyers pay to actually receive metal in hand on time in deliverable form. When premiums rise, it's not because people are bored. It's because inventory is tight, delivery is constrained, or demand is pulling supply faster than it can be replenished. So when you see Indian silver premiums surge to around $8, you're not looking at noise, you're looking at a stress fracture. And here's where the story starts to feel like a thriller, because the last time India had a major premium spike, the aftermath wasn't minor. There was a moment when Indian silver ETFs reportedly had to halt or pause adding new silver because they simply couldn't source enough physical to keep expanding. And shortly after, London faced its own episode of silver strain that became impossible to ignore. So now ask yourself this. If New York is high, Shanghai is higher. London has already had a scare. China's visible supply is thinning and India is paying up. What happens if one of these hubs faces a fresh shortage event? That's not a hypothetical for entertainment. That's the type of question that decides whether silver moves in a controlled stair-step step or a violent repricing. And here's the part that makes this even more explosive. Industrial demand doesn't wait patiently for a better price. If you are a manufacturer and your supply chain stalls, you don't just lose a little profit. You lose contracts, you lose deadlines, you lose reputation. In industries like solar, a delay isn't just expensive, it can be fatal. So when manufacturers start paying huge premiums, it's often because they're buying insurance. They're paying extra today to avoid disaster tomorrow, which means the premium spike is not just a number, it's urgency made visible. Now, I want to give you a quick cliffhanger before we go further, because in a minute, we're going to talk about the one decision hanging over markets that could pour gasoline on all of this. And when you see that connection, you might understand why the next move could be faster than people expect. But first, quick reminder. If you want daily posts, instant updates, and my personal takes that I don't always put into these public videos, there's a WhatsApp channel link in the description. Join it. I drop premium notes there, including voice updates and fast commentary that moves quicker than YouTube. All right, let's get back to the pressure map. We have three major arenas in this story right now: the Western Paper Hub, the Asian Physical Pole, and the global delivery network that connects them. New York is where futures trade and where the world watches the screen. Shanghai is where pricing can reflect local demand and supply realities, and where metal flows matter. London is a key delivery and vault center where shortages can echo across the globe. And India, quietly, is a demand engine that can suddenly become loud when manufacturing and investment buying collide. When these regions start flashing warning lights at the same time, it doesn't mean guaranteed crisis, but it does mean the probability of a surprise increases. And in markets, surprises are what create viral moments. Now, here's the legal and political spark sitting in the background. There's a major court decision looming tied to the structure and legality of certain tariffs associated with the Trump era. Prediction markets have been assigning odds, and at points, those odds have implied that the outcome could go against the tariffs with a greater than 50% probability. In other words, there's a real chance the system gets knocked sideways. And if the ruling goes against the tariffs, the financial implications have been described as massive, so massive that even discussing the numbers becomes a problem. The idea is that the money involved would be so large, it would take years to untangle what's owed, where it goes, and how to settle it. Now, whether you love that or hate that politically doesn't matter for this video. What matters is what markets do when the rules suddenly look unstable. They run, they hedge, they rush into what feels real. And right now, with gold printing fresh highs and hovering within range of the next major psychological milestone, the stage is set for metals to benefit from that kind of fear. In fact, gold has been trading so close to a gigantic round number that it's almost teasing the market. And when gold gets that close to a major level, people who never cared start caring. It becomes dinner conversation. It becomes headlines. It becomes trend. And when gold becomes trend, silver rarely stays quiet. Now, if you're still with me, here's your first engagement question. And I want a real answer in the comments. Do you think the bigger signal is the futures price in New York or the physical premium spike in India? Because one is a screen price. The other is what people pay when they must have metal. And here's your second question. If China's visible inventories keep sliding while India's manufacturing demand keeps rising, where do you think the next bottleneck shows up first? London, Shanghai, or India? Drop your take below. I read these, and it helps me decide what to cover next. Now, let's address the thing a lot of people get wrong in a market like this. They look at a high price and assume demand will vanish. That's sometimes true for luxury demand. It's often not true for industrial demand. Industrial demand is driven by necessity and timelines, not vibes. So, if silver is a key input and you're producing something that has to ship, you don't get to wait for a dip forever. Eventually, you pay the premium or you shut down. And if enough buyers are forced into that corner at the same time, that's how the physical market starts pulling away from the paper market. That's also how narratives break, because for years, people have been told that the paper price is the price. Premiums and shortages are dismissed as local issues. But when those local issues appear in multiple regions, the dismissal starts to sound like denial. Now, I'm going to say something carefully. I'm not claiming a global silver shortage headline has officially been stamped today in every market. What I am saying is that multiple canaries are wobbling. And historically, when canaries wobble across several rooms at once, you don't ignore it. You watch the exits, you watch the vaults, you watch the premiums, and you watch how quickly the story spreads. Because once the public catches on, the game changes. At this point, let me add a friendly reminder that builds the community. If you've had a win, maybe you caught a move, maybe you built a business, maybe you hit a personal milestone, share it in the comments. Your success story can lift somebody else who feels stuck. And it also tells the algorithm this community is alive. And now, as promised, here's a quick creative shout out inside the flow. If you want to hear silver-related success stories, real stories of people who made money and what they did differently, there's a link in the description to another channel. Go subscribe there too and watch how others built results. It's worth it. All right, back to the main thread, because the next section is where the tension tightens. Let's talk about spreads. When one region prices silver meaningfully higher than another, traders, refiners, and large players notice. That gap creates incentives for metal to move. But metal doesn't teleport. It has to be sourced, refined, transported, insured, and delivered. And every step introduces friction. When inventories are healthy, that friction is manageable. When inventories are thin, friction becomes delay, and delay becomes premium. So, an Indian premium spike doesn't exist in a vacuum. It can be an effect of global flows tightening, or it can become a cause that pulls metal away from other hubs. And here's a cliffhanger to hold on to. If India keeps paying up and China keeps pulling supply, what do you think happens to London the next time delivery demand spikes? Because London is the bridge between worlds. When the bridge shakes, the whole system feels it. Now, let's talk briefly about psychology, because virality is not just information. It's emotion. Silver is a market that humiliates people for years and then rewards patience in a way that feels unreal, that creates a powerful setup. Disbelief turning into shock. And shock is what people share. And when silver is boring, almost nobody forwards a link. When silver is ripping and premiums are exploding, everybody starts texting each other. That's why these moments matter. Now, I want to be transparent about how to navigate this without getting played. In a fast market, you will see two types of content explode. One type screams, sell now or you're doomed. The other screams, it's going to the moon tomorrow. Both are designed to steal your focus. Instead, focus on measurable signals. Premiums, inventory changes, delivery delays, and cross-market gaps. Those are harder to fake, and they matter to real buyers. Now, we're approaching the part where I need to deliver on a promise to the most serious supporters. By the time you're watching this, there should already be a members-only video published. That video pulls the full set of updates into one place and goes deeper than I can go here. More context, more connections, and more in-depth analysis. If you're really following closely, join the membership and watch it. It's also the easiest way to identify who is truly locked in. All right, let's bring this back to the present, because the market is moving and the timeline matters. We have a situation where New York is printing prices above the mid-90s. Shanghai is effectively higher, and physical markets are showing stress via premiums. Gold is also pushing into historic territory and hovering within striking distance of a major round number milestone. And there's a looming legal decision risk that could inject more uncertainty into currencies in trade. That combination is not normal.